Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to In the City. Each week we unpack a story that's crucial to the world's financial capitals. I'm Francine Lacqua. And this week, no surprise, the story, of course, that continues to be the focus of the financial world is the ongoing trade war, courtesy of one US President Donald Trump. So I want to spend this episode looking at the risks that the US tariffs pose to the UK economy. And one of those risks, of course, is disinflation. On Tuesday, Greene, one of the Bank of England's most hawkish policymakers, joined me on Bloomberg TV. She explained why she thinks while Trump's wave of global tariffs is expected to raise prices in the US, here in Britain, we might see the opposite. So I'm going to bring you some of the highlights from our conversation, but also with me here in the London studio is our UK economy reporter, Tom Rees. Now, Tom was with me in the interview with Meghan, and then he got a chance to speak to her himself to hear more on how the Bank of England might handle the next crisis. So good to have you, Tom.
Hi.
Welcome to the City of London.
The City of London.
The next station is Bank. Please mind the gap between the train and the platform.
The financial heart of the country.
The City.
The City.
Welcome to In the City.
Stand clear of the doors, please.
Tom, this is a central bank's worst nightmare because there are tariffs. You don't know whether it hits growth more than inflation. You don't know how the monetary policy reaction function goes, but you also don't know whether these tariffs stay or whether they're negotiated. So your models are all screwed up.
Absolutely. And before all this came about, the Bank of England was kind of dealing with the opposite problem, the kind of stagnant growth, but, inflationary pressure was still pretty high. The growth picture is obviously weaker, but it's the inflationary picture that it doesn't seem so certain on. Most people think, most of the effects of this are disinflationary. You've got kind of trade diversion effects, if Chinese goods have to find a different market. You've got oil prices have come down by, something like $14 per barrel. You've got sterling, which is appreciated against the dollar. Global growth is going to be weaker as well. So it seems like to most people, there's, a disinflationary forces will be on top, but the Bank of England has still been very cautious, still being a bit hesitant about endorsing that view. It still sees some risk. And Greene did mention a few of those risks in her interview, but she did say that she thought at the moment the disinflationary stuff outweighs the inflationary factors.
When it comes to tariffs in particular, for the UK, we're a small open economy, right? The US is our biggest single country trade partner, but the EU, of course, is our biggest trade partner overall. So if you have export substitution, then that would tend to push down on growth and inflation. If you have trade diversion from other countries that are trying to find a new home for their markets, that also pushes down on inflation. But we saw during the pandemic that if you have a repatterning of supply chains, that can push up on inflation. And also, if we have trade fragmentation writ large, then that tends to reduce knowledge spillovers, that reduces potential growth, that tends to be inflationary. So something you've mentioned was exchange rates. Yep. And those have not gone as the economic theory would suggest. Normally, if the U.S. announces or imposes unilateral tariffs on other countries, the theory suggests the dollar should appreciate. The opposite has actually happened. And so that in and of itself could be disinflationary for the U.K., but of course, as I mentioned, the EU is the UK's biggest trade partner, and the euro has appreciated. So net, if you look at the kind of sterling exchange rate index, the pound's up a little bit. There's a ton of uncertainty around this, but there are both inflationary and disinflationary forces.
Tom, when you look at disinflation, again, a central bank's worst scenario, or frankly, any policymaker's worst scenario, is to have inflation with weak growth, because then you really don't know what monetary policy looks like. What are markets expecting given all of the uncertainty of how the Bank of England reacts over the next 12 months?
So heading into Liberation Day, as it's now known, investors were really starting to doubt how many more rate cuts we were going to get in the UK. So there was about 40 basis points of easing priced in for the rest of this year about a month ago. We're now looking at over 90. So we've basically gone from doubts over whether we were going to get just one more cut to maybe 4 more cuts. So it is quite a big shift that we've seen. The bank's been on this very gradual path. It's been cutting rates at about once a quarter since August. And now we're looking at maybe back-to-back cuts, them speeding up the pace a bit. So we will probably get a cut in May. We might get another one in June. So it really depends on how the bank handles this uncertainty. They could be a bit more cautious and stick to this kind of once a quarter. But I think as we get more news of growth slowing, we had the PMIs, which were dreadful and really showed a kind of sharp drop in business sentiment. I suspect they might push towards a kind of quicker easing.
And Tom, you have all these competing forces, right? You have energy prices that for the moment are going lower. You have a weaker dollar. You have tightening financial conditions. You have this global demand worldwide that is slowing. So how does the pound, again, foreign exchange, which the dollar's behaving in a way that not many predicted, how is the Bank of England thinking about sterling dynamics and how that impacts actually the UK economy?
So this is one of the things that Megan brought up in the interview yesterday, and I've heard Deputy Governor Sarah Breeden mentioned as well as one of the big kind of uncertainties.
If the pound were to strengthen more, actually then we'll be importing disinflationary forces. If the pound were to depreciate, then the opposite would happen. So it just underscores the amount of uncertainty that we're looking at, given that we are basing our policy now on where we expect the economy to be in a year and a half, 2 years' time. It's pretty difficult.
But I mean, if you look at it at the moment, what's happened to the pound can only be disinflationary so far. So if that continues, then they'll have to consider that when they're thinking about whether to ease or not.
How complicated is it to set monetary policy right now?
Very complicated, and in the UK especially so, because we went into this with, relative to, say, the Eurozone, we went to this with a lingering kind of inflation issue. Everyone else seems to have got a lot more on top of some of the domestic inflationary pressures. In the UK, we still have wage growth that's above 5%. We've got services inflation that's still in the 4s, which just aren't compatible with having inflation, headline inflation at the 2% target. So it was already difficult going into that, and this just poses a whole new set of problems. I think the main issue for them is just the uncertainty about the kind of the end state. So the US tariffs on the UK were at 10% originally. That's the baseline. Maybe there's a bit more certainty. It's other countries where it's a bit more up in the air. And I think that does matter in terms of what happens with inflation. One of the questions that's posed is, will it cause supply chain disruptions? We saw that be quite important for inflation during the pandemic. And I guess what you could see is that there's a 90-day reprieve for a lot of countries. And do you see people stockpiling during that time? And maybe they rush to grab as much of certain materials as they can? Do US importers, do they try and find alternative suppliers from countries where they think it will end up with a lower tariff? So that end state is still quite uncertain. And I think that's going to be the problem for the Bank of England in the next 2 meetings, is that you don't really want to speed up and then you have these different forces suddenly kick in.
Tom, if you're the UK, so the positives are you have only 10% tariffs at the moment that can be negotiated down, but actually that's a better deal than a lot of other countries or a lot of other regions. I guess on the negative side is that you also have a fairly new government that was elected last summer with some of the policies and what they're trying to do. You wrote a great story on the budget deficit in the UK and the fact that the Chancellor may have to either increase taxes to balance the books and even cut spending a lot more. Yeah. So there's all these unknowns of what they've put in place when they came into power before Donald Trump got elected.
This is a bit of a nightmare for the government. At the spring statement in March, just a couple of days before Trump, announced all the tariffs, it already had to cut spending just to make the sums add up. There's no secret that in the UK, the growth picture is terrible. It means that we can't really spend more money. But this is a government that was kind of elected on a promise to revive public services. So it kind of stuck between those two pressures. And we had some more borrowing figures from the ONS, and they basically showed that borrowing overshot the OBR's forecasts again in the last fiscal year. And when we look ahead towards the autumn budget, her fiscal plans are predicated on some still pretty punchy growth numbers from the OBR. So the OBR have GDP growth getting back up to 2% or just under 2% next year. It just is looking a little bit optimistic given what's going on around the world.
Tom, I know Megan Greene in our interview didn't want to talk about the Fed, and this is very understandably, but how does the Bank of England kind of need to track the Fed in terms of moves a little bit because of dollar dynamics. There's, again, a belief in the markets, although it changes very quickly, that the Fed is kind of stuck, that they can't really do anything until the third quarter when the labor market probably slows down a lot, and that's when they start cutting aggressively. Does that influence what the Bank of England can do in terms of cuts this year?
That's part of that exchange rate picture that we're talking about. If we do see the Bank of England tracks the Fed roughly in terms of policy, but I guess what you might see is that diversion open up a bit more this year. As the Feds will probably have more of an inflation issue than to deal with than the BOE. So how it deals with that, because you've got the exchange rate, that's an issue, but another big thing is that UK markets, UK rate expectations are heavily influenced by what's going on in the US. There's a massive pass through between those two markets. And do you then therefore need the Bank of England to try and offset that, go more aggressively on rate cuts? But then you've got that whole, would that push down sterling further? Does that exchange rate problem come into play? So that there's a kind of balancing act there. So what the Fed does matter. Bank of England rate set is always trying to play that down, but it still needs to come into their thinking.
Yeah, we had a couple of wild days on the markets Monday and Tuesday because of a slight expectation. It wasn't fully priced in the markets, but Donald Trump was pretty aggressive towards Jay Powell. And so central bank independence has to be on the forefront of every central bank, including MPC members, because that's if you stop trusting that central banks are independent, then all bets are off.
Yeah, absolutely.
Credibility is the currency of central banks, and I think independence is quite an important piece of that. That when we say we will hit our target, and the target for the Bank of England is provided by Treasury, but we will hit our target. I think we can do so credibly because we're free to make the decisions that we believe will most effectively achieve that. And so I think central bank independence is absolutely crucial.
She was saying to me afterwards that she doesn't actually worry about the independence issue in this country, which personally, I think there is still a bit of an issue in this country, and I actually think it predates what's been going on in the US and Trump calling Powell a major loser, etc. We've had Tory MPs, people in reform, all sort of question the bank's independence, largely because we're just due to slightly different accounting arrangements around QE and QT. There's some huge fiscal losses from the bond operations in the UK. And it's something that politicians have. The borrowing figures this morning showed that in the last fiscal year, it costs the Treasury about 36 billion just from the losses from QT. So that's a huge amount of money that could be going towards, public services. So I actually don't think the independence issue is necessarily something that's confined to the US. I think that's something that, particularly with reform, and they're polling pretty much neck and neck with Labour at the moment, I think that could easily become an issue in this country as well. Yeah,
which is why it's so important what Donald Trump does in the US, although he has since walked it back and say he has no plans to fire Jay Powell. You spoke to Megan Greene after the TV interview, and it was really interesting. You talked about longer term, right? How they do and actually shape QE, how it could change during the next crisis.
Well, I kind of wonder whether this is slightly in response to what we were just talking about in terms of those political pressures, but Megan was saying that she saw scenarios in the future where we use QE in a kind of more targeted, a more sparing way. There's been a lot of criticism of the Bank of England, but other central banks as well, about them just flooding markets with QE during the pandemic. You had the supply side of the economy suppressed by lockdowns and things like that, and you were stoking demand. Some people think that helped to push up inflation. You've got very prominent people who think that, the ex-governor of the Bank of England, Mervyn King, is one of those. And I think we saw if you remember the LDI crisis during the Liz Truss era, just a reminder of that, we saw bond yields spike after Liz Truss's kind of mini budget of major tax cuts. That almost toppled a part of the pension industry, and the Bank of England had to intervene with bond purchases. The banks say that wasn't QE, but it certainly looked a lot like it. And it very quickly reversed those purchases. It sold them off very quickly. And I think what Megan was getting at is that maybe that could be a blueprint, not just for the Bank of England, but other central banks in future, and that you kind of step in, you kind of calm markets, but then you get out very quickly, and you're not left with these massive losses that we're sustaining now through the QT program.
So it was her main message that despite market volatility, the Bank of England should stay firm on unwinding QE.
Yes. Yeah. So we asked whether this bond volatility would maybe caused the Bank of England to rethink their QT plans. And she was saying, no, it's still running in the background. In September, we won't put market conditions at the kind of forefront of our thinking. And she was saying that there is like a kind of a get-out clause in the way QT is set up. So if QT was affecting bond yields by a lot, then there is a kind of get-out clause and they can stop it.
Tom, thank you so much. Thanks for listening to this week's In the City from Bloomberg. This episode was hosted by me, Francine Lacqua. It was produced by Summer Sadi, Moses Andam, and Tala Ahmadi. Brendan Francis Newnham is our executive producer. Special thanks to Tom Rees and Megan Greene. Please subscribe, rate, and review wherever you listen to podcasts.